So let's imagine a world where gold is the accepted form of currency. Let's see what a typical economic transaction looks like. So let's imagine that we have one person over here who wants to sell shoes, and we have another person over here who's interested in buying the shoes. He has gold coins. So the transaction will look as follows. This person over here will hand over his shoes, and this person over here will hand over the gold coins. Now in 17th century England, goldsmiths noticed that this was going on, and they thought of a business that they could start. Goldsmiths were already used to dealing with large quantities of gold, so they had these large vaults sitting in the basements of their shops. And so the goldsmiths had a simple proposition. They went to these people over here who were carrying around gold coins, and they told them, hey, why don't you keep your gold coins with me in my vault where it'll be safe, and in return I will give you little slips of paper that tell you how much gold you have sitting in my vault, and that if you bring to me, I will return your gold at any point, and in addition to that, I will pay you a rate of interest. And so the person over here with the gold coins is probably thinking, wow, this is a no-brainer. I wasn't feeling particularly safe about my gold anyway because I'm keeping it under my mattress, and now I get to keep it in a goldsmith's vault where I know it'll be safe, and I get paid a rate of interest to do that. So for the people who are carrying around gold coins, this seems like a terrific deal. So now let's see what our original economic transaction, the one over here, looks like now. So this person over here will still hand over his shoes to this person who's interested in buying them, but this person who previously handed over gold coins will now probably, instead of handing over gold coins, will hand over these little slips of paper and tell the person selling shoes, listen, you can take these slips of paper to the goldsmith and you can pick up the gold yourself. And it's very likely that the person selling the shoes will go along with this. Now the question is, what happens next? Will the person who sells the shoes, will he go to the goldsmith and cash in the little deposit slips, or will he use those deposit slips to buy something else? So just say our shoe seller wants to buy milk. So it's very likely, because it's so much more convenient to carry around these little notes or deposit slips, that our shoe seller, if he wants to buy some milk from this person over here, will just hand him the little slips of paper and expect milk in return. And so you see what's happening is that because people trust that when they go to the goldsmith with these little slips of paper, they will get gold in return, they are happy to be trading these little slips of paper as money instead. And as you can imagine, the goldsmiths notice this happening. But first, just to keep things clear, let's set up a specific example. So let's assume that, similar to how this person over here kept his gold coins with the goldsmith, there's a whole bunch of people who've chosen to deposit their gold coins with this goldsmith. And so I'm going to put them over here. So there's a whole bunch of these people who have given the goldsmith 1,000 gold coins, is what we're going to assume, and in return have received these little deposit slips, plus have been promised a rate of interest. So we're going to refer to these people over here as depositors. And there's 1,000 gold coins sitting in deposit. So now the goldsmith has 1,000 gold coins sitting in his vault, and he notices something. He notices that it's very unlikely that the amount of gold sitting in the vault fluctuates by much. And the reason that would be true is because people are happily trading around his little deposit slips for money and aren't actually picking up the gold. Occasionally someone will come and pick up some gold, but it happens more and more infrequently. And so just say the goldsmith has 1,000 gold coins sitting in his vault. He might see on an extreme day at most 50 gold coins in withdrawals. And so he thinks to himself, you know what I'll do? I will keep 100 gold coins in my vault as a reserve. I will think of that as a reserve, and then I will be willing to loan out the other 900 gold coins. So let's keep track of a couple of things just to make this clear. Over here, we're going to keep track of how many coins the goldsmith has in his vault. And if we imagine that we're the goldsmith, here we're going to keep track of money owed to us, and here we're going to keep track of money we owe others. The typical word for money owed to us are our assets, and the commonly used word for the money we owe others are our liabilities. So now the goldsmith, as you recall, has 1,000 gold coins sitting in their vault, and they owe these depositors over here, their money back if they want it. So our liabilities, as the goldsmith, are also 1,000 gold coins. Now, as we were saying, the goldsmith noticed that the balance in his vault didn't fluctuate by much, and so he decided to keep 100 gold coins as a reserve and to loan out the other 900. So let's imagine that in this city that the goldsmith lives in, there's someone who's interested in building a bridge. And so we're going to call that the bridge project. And this person who's building the bridge really needs a loan for some money. And it just so happens that the amount of money that he needs is 900 gold coins. And so what the goldsmith does is he will basically loan out the 900 gold coins to this bridge project person and charge him a rate of interest. But how do you think that the goldsmith is likely to loan out the money? What's very likely is that he'll just hand the bridge project guy some of these slips that he's been handing out over here. And so he will give the bridge project guy these slips that are backed by 900 gold coins, plus charge him a rate of interest, plus charge him a spread, which we're going to assume for the time being is 5%. Now, this interest rate over here will be the same interest rate over here. The reason he has to charge this spread of 5% is for two reasons. One is to compensate him for the risk that the bridge project person won't be able to pay him back. And the second reason is so that he can make a profit on this entire service that he's providing. So let's update our table over here. The goldsmith still has 1,000 gold coins sitting in the vault. His liabilities, meaning what he owes to other people, is still 1,000. These depositors haven't gone anywhere. He still owes them the money if they choose to withdraw it. But now the bridge project person owes him money because the goldsmith has loaned out that 900 coins to the bridge project. And so the goldsmith's assets are 900. And so we're going to refer to these people, such as the bridge project person who loaned money out, as borrowers. So what do we think the bridge project will do with the money that the goldsmith just gave them? What's very likely is that they'll have to hire workers to actually build this bridge. So we're going to assume that the entirety of the 900 gold coins that the goldsmith loaned to the bridge project is spent on workers. So I'm going to draw that over here. So the bridge project has to pay all these workers. And how do we think the bridge project is going to pay them? It's very likely that they will just hand them these 900 gold coins worth deposit slips and tell the workers, listen, if you take these slips and you go to the goldsmith, they'll give you gold in return. So let's update this table over here. We now still have 1,000 gold coins in the vault. We have assets, meaning the bridge project person owes the goldsmith, us the goldsmith, 900 gold coins. But now these workers think that they can take these 900 gold coin back slips and go to the goldsmith and pick up their gold at any time. So we as the goldsmith, we owe them 900 gold coins if they come to us and try to cash in these slips. So our liabilities, as in what we owe to other people, is this 1,000 gold coins from these original depositors, plus this 900 that we owe to the workers. And that's a total of 1,900. So we have 1,000 gold coins sitting in the vault, we have assets of 900, and we owe other people 1,900 gold coins. So you might be thinking, what on earth is going on? There's only 1,000 gold coins actually sitting in this vault, but now somehow people out there, these people plus these people, believe that there's 1,900 gold coins in that vault. How does this make any sense? We'll talk about this more in the next video, but for the time being, the point I'm going to make is that this system that we've described is very similar to the banking system under the gold standard. In fact, all you have to do is just change some definitions. You change the goldsmith to a central bank plus a commercial bank where the division of labor is that the central bank sets this interest rate over here, and the commercial bank is responsible for taking money from depositors and loaning it out to businesses that need them.